today's in today's session we are going to uh, see about what is recoverable debtors. Okay, recoverable debtors and allowances. Recoverable debtors and allowances. That means an irrecoverable debt is where we are reasonable that the receivable is not going to pay. The amount receivable from the debtor, we are not going to receive. It is then reasonable assumption. We are feeling that he won't pay. The debtor won't settle our debt. That is means irrecoverable debts. Irrecoverable debts. Okay, and that is for an example. Uh, we are we have sold, right? Sales account, debit and credit. Okay, and debtor account, debtors, debit and credit. Okay, here when we make sales, we used to credit the sales, right? Okay, and debit the debtors. Now we have to receive this amount because we have shown in the accounts as sales and receivable the certain amount. So we have to get this amount. But if we say Mr. X is not going to settle this amount, then we have to, that is, we are certain we have to remove that from the accounts. We have to remove it. We removing, and we have to treat that as a bad debt. Okay, bad debt. Debit and credit. Here we will say data. We here say sales. This one is bad debt. Bad debt. Here we will say debtors. Because this is the bad debt. This one will show in the profit and loss account. Okay. For this bad debt recoverable data, we will say irrecoverable accounting treatment, right? Treatment. Bad debts for number one, right? This is number one. Recoverables one. Doubtful debt is number two. Irrecoverable irrecoverable debts. For that, bad debts debit, right? Debtors account, debtors account credit. Here debit, you have to credit. This is what we did it here, right? we are not going to receive. So sales, the bad debts arises when we make the sales on credit, right? We had sold goods on credit, then sales income credited. Okay, then we sold it on the credit, no, so we are debiting to the debtor account. That is the first adjustment we used to do. And if we say it is irrecoverable, then we have to remove it from the debtors, then debtors account credit and bad debts account debit. Bad debts is the account which is arising there because it is bad debt, it is become bad, we have to remove it. So we are creating an account bad debts. Okay, so bad debts is here, that is a double entry, bad debts debit, debtors account credit for this irrecoverable amount, because the person to whom we have sold would have dead. So, right, due to his death we cannot recover his amount. Once if he die, can we recoverable his debts? No. In that case it is certain, right, it is certain that we are not going to receive it. That's what we have made the exact amount and credited to the bad debts. Second one is doubtful debt. Doubtful debt in the sense, a doubtful debt is where we are worried that the receivable might not pay, right? We are, this is example for number one, right? Irrecoverable, right? Next one is, I am going to say doubtful full debts, because we are making the sales. Okay, we are making the sales, right? Here debit, here credit, sales, here it is debtor, debit and credit, CR, debit and credit, right? Here in a specific allowance or doubtful debt, a doubtful debt is where we are worried that the receivable might not pay, he might not pay, right? We are thinking that he won't pay because we are sending letters after letters, right, that this much of amount is outstanding from you, please settle this, kindly settle this before this specific date. But that customer debtor is not answering, he is not responding any correspondence, or he is not answering our phone calls. That means he is not going to pay. It is a doubt in our mind, it doubt has arisen that he won't pay, right? So we have to make a doubt, he won't pay, sometimes he might pay, it is depends on his mind, right? So it is doubtful he will pay or pay not, may not, because we don't know the reason why he is not answering the calls and why he is not responding to our correspondence, right? So we say here, we will say sales is sales. Here debtors is debit, right? Sales, right? Okay, now we we think that he won't pay. In this case we are specific that this particular person not going to pay. So if we say this is 1000 sales, debtors amount is 1000, 1000 we'll say, debtors also 1000, right? Out of this 1000, the person who is not going to pay is 100 rupees, right? he, he is the person not going to pay, so his specific accounts going to or making provisions for receivable, right? So for that we can say, for this person the 100 only we can make, sorry, we will say, 100, 100, right? 100 we will say debtors account 100, right? Debtors, this is, we are going to make a provision, right? It is not, we are not going to say this here. We are going to open a bad debts account, bad debit and credit, bad debts, right? Here we will say provision for bad debts, or allowance for bad debts, debit and credit. Here or allowance or provision for bad debts, okay. Then here we decided to make a 100 rupees, sorry, not the data's one not going to affect, we are decided to go for the 100 rupees provision. Then we are saying 100 bad debts, here we will say provision for allowance, or provision 100. Here we will say credit bad debts account 100, okay. This is the double entry for specific, we know that this specific person is not going to pay. This is the double entry. Bad debts account debit, provision for bad debts is credit. So here accounting treatment, specific accounts making for receivables, right? Not like doubtful debts, you see. Okay, bad debts debit and provision, allowance or provision provision for bad debts, yes, credited, okay, credited, okay. For doubtful debts, we are doubt whether we receive or not, we are making bad debts account debit and provision or allowance for bad debts credited, okay. That is the adjustment for bad and doubtful debts. So here we are certain, in irrecoverable we are certain that amount is going, we are not going to receive, because the person who bought the goods on credit passed away, died, so there is no way to get the money. We are certain, because of that we are deduct directly credited to the debtors and debited to the bad debts. Here we are not certain. Here in doubtful debts, we are not certain whether we are not going to receive or not, because in that situation we make this adjustment, because debit bad debts and credited to allowances or provision for bad debts. Okay, and here again they says this is the specific allowance, right? Then second one, because here specifically one person is doubt, for that we are making allowance. Here general allowance, okay, general allowance for or provision for trade receivables, right? Provision for receivables. It may be that in our company it is the nature of the business that know that on average, say 5% their debtors of their debtors debtors uh, end up not paying, right? Normally in our organization 5% of the debtors are usually not going, they don't pay. So in that case we used to make a provision for 5%, right? Because we are not going to pay, they are not going to pay. If that is the case, if this is 1000, right, this is for the specific, right? If it is the 1000, this is for specific. Okay, another one is if it is for 1000, what is the 5%? 5% is 50 rupees. Okay, we had to make a 5% for the provision, means 5% is 50 rupees debit allowance, right? Here 50 rupees credit bad debts, right? It is a general provision. Here we will say specific provision, here we will say general provisions. Okay, provision we are making 5% specific and general. Okay, understood? So this is the bad debts, irrecoverable bad debts. One is recoverable, we cannot receive it, and total uh, total we don't receive. And here doubtful debt means we are doubt that whether we will receive or not, doubtful. In that doubtful also we specific amount, we used to make adjustment for specific amount or a general allowance. If we find the person, this particular person is not going to pay, then we will charge for his account that amount only. That otherwise, if general, talking about general in the sense, if the persons are not paying, the debtors are not paying generally 5% of our total value, in the sense we can make a 5% provision or allowance every year, right? But having said that, if the person, the debtor is not going to pay, means due to some other various reasons, he may end up with the uh, some differences or with our opinion or something like that. So many reasons are there, may be there for not paying. So we can go for the legal action. Understand? If we are making the credit sales, and if the person bought the goods and on the credit sales, and if he's refusing to settle the amount, in the sense the company is going to bankrupt. Okay, so company will assess whether this person going to pay or not. If it is not paying, they will see whether they can go for the legal action, or whether they can sue you in courts, right? And if they are going to sue, how much it will cost for their legal actions, right? And how much they will compare that amount with your receivable amount, right? If the receivable amount is lower than the cost of legal actions, then they will avoid going for the cost of the legal action, and they will simply write off the amount from your books, from their books. That is the thing. Okay, here exam question is, at the end of the first year of the trading, there is a balance on the receivable account of a street of 500,000, right? Balance brought forward 500,000. We have put it the debtors, and on investigation, this amount is found to be involved debits debtors from debtors. Okay, debts from A and B, which are to be regarded as irrecoverable. A and B debtors are irrecoverable, right? A and B irrecoverable, right? They have seen from the investing that also included in this balance, right? Regarding recoverable, the amount owing are 2,500 and 1,500, 2,500 and 1,500 owing, respectively. In addition, there is 3,000 owing from M 3,000 owing 3,800, right? Owing from M is regarded as doubtful debts. This is bad. These two bad, right? This is doubtful, right? And the company has the, in addition, there's a M is regarded as doubtful debts. Street has a policy of maintaining general allowance on receivables of 4%. 4% on debts, receivables. 4% on receivables. If we jot down the facts, if you summarize the facts, it will be easy for you, right? So now extract in P and profit and loss and balance sheet they ask. Extract, before doing the extract, we have to first open the T accounts to understand, right? A and B are bad debts, right? First you had to remove this from debtors account, right? The total is 2,500 a bad debts. Okay, bad debts. You can take the total, but for your understanding purpose I am putting A, right? A, okay, A is 2,500, 2,500, and B 1,500 credited and debited to 2,500 and 1,500. Okay, debtors. Okay, A and B. We have made a entry for first mistake. This is one bad. These both are become bad. These both are A and B are bad because they says instruction this amount won't involve debit from A, debts from A and B are to be regarded as irrecoverable. Regarded as recoverable. A and B. Recoverable. A debts from A and B. Right, respectively 2,500 and 1,500. 2,500 and 1,500. In addition, there is 3,800. In addition, there is 3,800 from M is regarded as doubtful doubtful debts. It is regarded as doubtful debts. Not certain whether we will receive or not. We don't know. That is 3000 from M. Then what is the entry we has to pass? Debtors account debit 3800. Sorry. Bad debtors account debit 3500. 3800. 3800 bad debt provision. Provision or allowance. Allowance or provision for bad debts, right? That is 3800. Bad debts. Then here we used to say M. This is M, okay? Here we used to say bad debt. How much? 3800 from M, right? From M. Because we are not certain the person whether he will pay or not. That's what we have made bad debts debit. Allowance for bad debts and doubtful debts are credit. Okay. And third one, last one, they says they have a maintaining a general allowance for receivable only 4%. Okay, 4% they have to pay on total. They have to provide 4%, right? How much is the 4%? 500,000 into 0.04. It is 20,000. 20,000. Its policy is making the provision for 20,000. How much up to now we have made? Okay. Here we will say carried down balance. Okay. Here we will say uh, here we will say carried down balance. Okay. Carried down balance should be 20,000. Right. This should be the bad and doubtful debts. Okay. We used to make the provision for 20,000 normally. Now in this case we have made a provision for 3,800, right? And debtors also 2,500, 3,000, 4,000, 4,000 and 7,800, right? It has a policy of maintaining a general allowance of receivable 4%. So we don't mind about these. We have to mind about the carried down balance should be brought forward balance brought forward should be 20,000. Sorry, balance brought forward should be 20,000, right? We are not bothered about other thing. Balance carried down should be, then we balance here 20, here 20,000, 3,800 only we have made that bad debts adjustment we have made. So rest is 16,200. 16,200 means this should be, we have to make a provision bad debts, bad debts. Okay, here we will say allowance for provision or allowance or provision for bad debts is 16,200. 16,200. Okay, so if you balance here bad debts 1, 2, 18, 20, 24,000. Bad debts 24,000. Okay, PNL, we used to say PNL 24,000. You have to transfer this amount to PNL. This amount is carried forward. This will go to the profit and loss account, right? This debtors will come to the balance carried down 500, 3, 4, 496,000, right? Here 500,000 balance brought forward 500,000. Sorry, 496,000. 496,000. Okay, so extract, what they need is extract of profit, balance sheet and profit and loss account. First debtors, right? Balance sheet, go to the balance sheet. What is the debtors? Trade debtors. How much? 496,000. Second one, bad debts. Bad debts goes to profit and loss account. Here profit and loss account under distribution, sales and distribution expenses. Then we say bad debts. That is 24,000. 24,000. Okay. Then allowance for bad and doubtful debts is 20,000. Allowance means provision for bad debts. Here that go, we have to deduct it from the provision for bad, provision for allowance or provision has to be deducted from the debtors and shown in the balance sheet, right? Debtors will directly charge to profit and loss account. Okay, debtors directly we used to charge it to profit and loss account, and in the balance sheet provision is shown under the balance sheet by deducting from the debtors amount. Provision, allowance for bad debts. Okay, allowance for bad debts is 20,000. Then 476,000. This is the value of trade debtors. This is the value of trade debtors. This is how we used to show in the balance sheet. Okay, have you understand? Because here trade debtors is carried down, the balance is 500,000, right? There we have written off the 2,500 and 1,500. that is 496,000 is the trade debtors. From that, the company's policy is to have an make a provision on 4% on the opening balance brought forward, right? The 4% is 20,000, right? This 20,000, 4% on receivables, okay, 20,000. So this 20,000 should be here, the allowable bad doubtful debts, that is 20,000, right? Here we have to put the 20,000, carry as we have to make it as a carried down balance 20,000, and balance it here, balance it, and here you have to say brought down, brought forward balance is 20,000. This 20,000 should be here, and here balancing amount, that is 20,000 minus the bad debt for M 3,800. If you deduct it, the balancing figure is 16,200. The 16,200 should be shown under the bad debts, right? Here bad debts, here bad debts, 16,200. So the provision should be equal to the 4,000 of the 500,000 to show in the balance sheet, or we have to show as a brought forward balance. Here we have mentioned that 20,000 here balance, credit balance, and we have to deduct it and show it here for as 476,000. This is a provision only, allowance given for the assessment that particular 5% or 4% people won't settle their reserve amounts due to us, right? Sometimes they may settle. That's what we made a provision that if they have settled, then we can reverse this amount. That's what we didn't straight away debited to debtors. If it is confirmed only, we have to deduct, we have to credit it to the debtors, right? If we are confirmed that the people confirmed that person is not going to pay, or we are not going to receive from that person, only we have to say this here credit. Okay, have you understood? So I am concluding this lectures, and I hope to see you in next lectures. Okay, thank you.